the market is a pretty harsh environment, and there's not a lot of charity among investors or traders at all.
Welcome back to Patrick Boyle on Finance. There's been a lot of news over the last week or so relating to GameStop. And so I'm very excited today to bring on my guest, Victor Haghani, who was a former partner at Long-Term Capital Management. He has since gone on to set up a new fund management business called Elm Patrners. I'll give you guys a link to that in the description below. But in today's conversation, we talk about GameStop, we talk about the silver squeeze, we talk about whether hedge funds really do help each other out, because that is one of the big narratives that I'm seeing in the news right now, that hedge funds are helping each other out and they're at war with retail traders. We'll see what his thoughts are on that topic, how he invests his money today, what he thinks of things like short selling and trading options, how spread trades work, and what his life is like post LTCM. Well, we'll get going, and I guess the very first question that I want to ask you is just about your overall career path, because on my channel, I've recommended to a lot of viewers, people often ask me what books on finance should they read, and I put up a top 10 list, and on the list is Liar's Poker and also When Genius Failed. And so you're in 20% of the books that I recommend. And I guess I just wanted to ask you, you were quite a young guy in both of those books. And I guess I just wanted to ask you about your career path. Like, you started out at Salomon Brothers. What was that like in the 1980s at Salomon?
Well, it was a wonderful, exciting time, with lots of change. It was on the back of the deregulation of interest rates and the beginning of derivatives markets on financial instruments and so on. It was just a wonderful time where there was a feeling that we could come up with all kinds of solutions that would improve the welfare of clients. There was a real use for many of the instruments in terms of risk sharing and risk transfer. And that being at an investment bank that was open to doing these things was a great opportunity for career advancement and to earn a lot of money, et cetera. It was a really special time, and it was a time when there was this movement of people and ideas from the laboratory into practice that was really exciting. And all kinds of Nobel laureates and game theory and economics and finance, were coming themselves to be involved in Wall Street, but also, a lot of their students, were turning up and really making, overall lots of improvements, even though there were big bumps along the way.
Did you go straight into the bond arbitrage group, or what happened, like when you started at?
No, I started off in research. I studied at the London School of Economics, which gave me a pretty good understanding of a lot of the basic quantitative techniques that we were using and developing in research. So I started off in research for a few years, and then I was invited out to join the trading desk, and then I stayed working for John Merriweather for my whole career until I took a long sabbatical starting in about 2001 for 10 years. And then, I wound up starting Elm Patrners, which was, is one of these businesses where I built Elm Patrners to help manage my family's savings and wealth, such as it was after LTCM. And just found that a lot of people were looking in the same direction of wanting to have the benefits of indexing, low cost, diversification, transparency, tax efficiency, but realize that when you say you want to use indexing, that there's still more decisions to make, and we were helping people, or we help people to make all those decisions and keep costs low and diversification high, and kind of keep the eyes on the road ahead, rather than being totally passive and letting anything happen.
You've made quite a transition, because I guess in truth, probably the more obvious thing would have been to stay in fixed income or to, stay on the hedge fund route. Now, when you guys started at both Salomon and at LTCM, the whole fixed income arbitrage idea was kind of brand new, right? Like that wasn't a trade that was widely done at the time, was it?
Gosh, that's a good question. I think that's fair to say. I mean, I think that John Merriweather and people similar to him at other firms really kind of pioneered things in the late 70s. So by the time I joined in 84, it had been going on for a while. But I think that, yeah, definitely that was the start of it. Although I did get very friendly with Gene Cottrell. I don't know if you've ever heard of him, who eventually became the managing partner of Phillips and Drew, that eventually got bought by UBS and the Big Bang in the UK. And Phillips and Drew was kind of like a Salomon Brothers, but in the UK, in London. And it was amazing, how much sort of quantitative fixed income analysis was being done at Phillips and Drew. I mean, it was a real soulmate to Salomon and some of the other firms specializing in fixed income in the States. But the understanding of the fixed income markets and so on, is like probably somewhat traces to Marty Leibowitz and in his book Inside the Yield Curve. And his work with Sidney Homer and so on. But really, in terms of putting these things into practice in a long, short sort of framework, you're right. I think it really started in Salomon and a few other firms in the late 70s with people like John Merriweather, getting it all going.
Now, while LTCM wasn't the sort of first hedge fund, it was probably the first famous hedge fund. I think, at least to me, it was. I had never heard of a hedge fund before LTCM. And obviously then in the early 2000s, as the dot-com bust occurred and the markets fell, the whole hedge fund industry became huge. And today, almost everyone knows what a hedge fund is. But you obviously left that industry. I'm really interested in your overall thoughts, but to a certain extent, I would argue that the industry has become awfully crowded in that, LTCM was massive at the time, while today it would almost be considered a mid-sized hedge fund, right? Based on the size of some of the other firms out there.
Yeah, or possibly small. No, but there was a pretty thriving hedge fund industry when we set up our firm in 1993. That Soros, for instance, already had a pretty long track record. I mean, a bunch of the sort of the all-time greats, of the hedge fund world were already in business for quite a long time. I mean, Steinhardt had been super successful, in more than a decade before we set up. So there was a big field of hedge funds. In fact, it's funny, when we got started, we were so different than the other hedge funds where, Steinhardt and Soros and Tudor and so on were really, long, short, speculative, very heavily into futures and liquid things and so on. And when we started, we tried to tell investors, well, we're kind of different, maybe think of us not so much as a hedge fund in terms of this broad mandate, but that we're doing, this relative value business. But yeah, I mean, it's certainly grown tremendously. And of course, the first hedge fund, I think, goes all the way back to maybe to Ben Graham, and, Warren Buffett got his sort of start with effectively a hedge fund. But I may have lost a little bit of track.
Well, no, I just almost mean that no one had heard of them. Like today, someone at a bus stop knows what a hedge fund is. When I started in
absolutely
2001, I started working for Vic Niederhofer, and that was in Connecticut, sort of in hedge fund central. But, if you told someone you worked for a hedge fund, they almost thought you were a gardener or something. Like the term wasn't widely known,
Yeah. Well, I didn't realize you worked for Victor Niederhofer. That's quite an experience, and I've read his book or one of his early books, and I heard him on a podcast recently talking maybe with Tyler Cowen or somebody. That was really interesting to hear him talk about his history, or not Tyler Cowen, but some podcast. Anyway.
Yeah. Victor is a joy to be around. Like it's a few years since I've met him, but one of the last times I was walking around New York talking to him, and I just thought, gosh, this guy has ideas. Like he's a big mind, you know?
Yeah, I really enjoyed hearing him talk about his life on this recent podcast. Yeah.
Yeah. So tell me about, like, obviously when things went wrong at long-term capital management, what was it like? Because I imagine that you had what, probably over a decade of sort of phenomenal success, like things probably just kept getting better for you, and then suddenly all the air got sucked out of the room. What was that like?
Well, it was. I mean, obviously, it was a terrible experience. That I mean, it's bad enough to um, to lose money. It felt being in the limelight and so on was terrible. But the what mitigated it somewhat was that the group of partners really stuck together, and we operated mostly on a consensus basis. So individuals didn't feel that the weight of the whole thing wasn't on one individual's shoulders as much as it might be in less of a you know, consensus oriented organization. I mean, not that everything was perfectly smooth, but in general, that it felt more bearable, in that we were in it together by and large. But the really big, I think the really biggest lesson or interesting thing to take away from LTCM that hasn't really been discussed or appreciated, I think, enough, in terms of when the books about LTCM and the case studies and so on were written, is really to do with the the fact that the partners, myself included, that we all had so much of our own savings invested in LTCM, and it's interesting. Like I think that's still in many cases, not in all cases, but in many cases, um, entrepreneurs and fund managers and businessmen, um, are just a little bit too, are can be too concentrated in their own businesses or funds, and I think that, one of the things that I've really come to appreciate post LTCM is how the insights of, from von Neumann and Morgenstern all the way up through, financial economists today, in terms of helping us to understand choice theory and making good financial decisions under uncertainty, that whole field is kind of undertaught and underappreciated. And I wish that I had a better appreciation for it at the time, and how a very simple expected utility analysis, would have really strongly suggested to all of us partners that we should have had a lot less of our own money invested in the fund itself, as attractive as the expected returns seem to be. That the combination of having so much of our money in our fund and then our own ownership of the management company, that so if you thought that, oh, I'm going to have 80% of my money in the fund, in the LTCM fund, and that might seem kind of, let's call it, reasonable or prudent, 80%, because you still have 20% on the side if everything goes wrong. Well, the thing is that if the value of the management company was probably, for all of us, was worth more than the value of our financial assets that we had in the fund. So 80% invested in the fund was really like 90% invested in the business, and now
Yeah.
it starts to look kind of crazy. And especially if you just think about, if we had lost 30% at LTCM, the management company value might have gone all the way to zero. That we didn't need to lose as much as we lost in the fund for the management company to have been permanently or very significantly impaired. So I think, that lesson is really important. And
It's an interesting thing because for investors, they want to see you kind of essentially all in. They want to feel that if they're going to take a hit, that you're in the same pool as them. And I often think, when you hear about people talk about like Jeff Bezos, for example, and his huge wealth, but obviously that's largely tied up in a company that he started? And for example, should he start selling down his shares and diversifying into the S&P? That would send quite a bad signal to the market, you know. So to a certain extent, as a fund manager or a business founder, you're almost forced to not be diversified. But then that then sometimes leads to either huge wealth being generated or someone's entire wealth being wiped out.
Yeah. Well, I think that for fund managers, I think the pressure is a lot less, because with entrepreneurs, there's the control issue. So, that I think sometimes entrepreneurs wind up holding on to a lot more than would make sense from a risk-adjusted point of view, because they need or want to maintain, the appropriate voting control of the entity. But for fund managers, I think that investors are pretty savvy and like, okay, they want to see the manager with some skin in the game, but they also know that, like if the manager is really trying to put all their money in there, that they're going to wind up, in most cases, they're going to wind up getting kicked out, And so is it really, like if you're investing in a hedge fund or, where that the manager really wants to keep reinvesting his incentive fee and all of that back into the fund, you kind of know that your days, that if you pick the good manager, you kind of know that your days are limited with that manager. And then if things go bad, well, you bear the bad outcome. But in the really great outcome where the manager has found that sort of secret sauce that really can generate sustainable high Sharpe ratios, you kind of know that you're going to be out. So I think with fund managers, I think the pressure is less than people think. And I think that the fund managers can make bad decisions when they have all their wealth on the line too. That really the fund manager should be acting as an agent for the investor. But when the fund manager has all his money in there, it's difficult. Which hat do you wear? Like, again, going back to LTCM, at some point in the crisis, we felt that we had a fiduciary duty to our investors, and so we tried to wear the hat of our investors. And even though we, as individuals, we might have wanted to just get out and save some of our wealth with a liquidation at a big down print, we thought, well, our investors all have a small amount of their wealth invested with us, so they're not facing the financial distress the way that we are. So we should do what we think is right for them, and instead of accepting a huge down bid from some entities to take over the fund, and leave us with a down 70% or a down 50% outcome, we thought it made sense to see if we could raise some capital and preserve more of the value that was there.
That, I guess, leads in slightly to the GameStop story that's going on in the market right now, where the problem is that this story is tied to so many market technicalities that a lot of people don't, I feel, fully understand what's going on. But one story that I think a lot of people are putting forth, which I believe to be wrong, is the idea that Wall Street is looking out for their own, and that the individual investors are getting the rough end of the deal while Wall Street tries to defend the hedge fund. Now, I know your experience, at least in the Lowenstein book, the story was very much that certain banks and other hedge funds who were invited in with the idea of possibly stabilizing the market did the exact opposite. Essentially, they widened the spreads on you guys in order to sort of profit from the unwind. What are your thoughts on sort of how traders help each other out in tough situations?
The market is a jungle, and everybody's out for themselves. No doubt about that. And I think that I don't know which journalist used the term bailout for LTCM, but I can tell you that the partners of LTCM didn't get bailed out. I mean, we sold out. We sold the portfolio of trades that we had, down, I don't know, 90% to a consortium of 13 banks. So there was no bailout. I mean, if there was any bailout, the Fed was orchestrating these banks to come together to stabilize things. I mean, in some ways, you could say that the Fed was bailing out the banks, but there wasn't a bailout. There was no transfer. There was no transfer, of money, to people that got into trouble or anything like that. I mean, so, and indeed, the market's behavior in the lead up to LTCM wasn't to say, oh, let's all get together so this doesn't happen. I mean, everybody was just in a frenzy of liquidation of everything. So, I think I would find it really doubtful. I mean, that, if Point 72 was an investor in Melvin Capital, I think that they would just be thinking of their own interest in terms of wanting to invest more in there to stabilize it. I don't know the details at all of the situation, but, I would say in general, the market is a pretty harsh environment, and there's not a lot of charity among investors or traders at all. If anything, I could imagine that, that people seeing the dynamic that anybody that could identify these dynamics of the GameStop situation and related situations would actually try to get on the bandwagon rather than trying to somehow altruistically stabilize the market. So I'm sure that there were some, that we'll find out that there were some sort of establishment traders that were that were riding some of these trends and exacerbating some of these trends, rather than somehow altruistically trying to stabilize things for the benefit of anybody else.
Now, another question that relates to this is about the silver squeeze that sort of, happened yesterday. And I would be interested in your thoughts on, I think there's a new viewpoint in the market amongst certain investors that you can sort of all get together and pile in and sort of bully the market to your price. Now, I would argue that you never want to do that, because if you move the market on the way up, it's almost like a conservation of energy idea. If you're taking a big position is going to push it up, you're exiting that big position will push it down, and almost nothing will have happened. What are your thoughts on people trying to trade in size and make the market do what they want?
Well, I'd say a couple of things. I mean, first, look, there's nothing new under the sun. I mean, it's amazing if you read, Adam Smith's Wealth of Nations, and, all these things that he's talking about in the late 18th century are like things that we can recognize in our economies today. And then, more recently, a lot of us Wall Street guys have loved the book Reminiscences of a Stock Operator. And, sort of these syndicates pushing things around was something that was going on back then in a less regulated environment. So, it's not that this stuff is new. I think, the general idea of trying to push things, and then liquidate, in general, that's a tough strategy to make work. However, there are these special situations. I think we could refer to them as when there's trades on close, right? That to the extent that there are certain situations where there's trades that are going to happen at the closing price, for instance, no matter what the closing price is, then pushing things can make a lot of sense. Although I think that in many cases it is over the line, or it could be over the line in terms of regulatory and legal boundaries. So what seems to have happened, for instance, when oil traded to negative $38 or $40 a barrel, is that a bunch of people had these orders to sell, that they needed to sell on close, right? So you had a bunch of oil traders that realized that there were some really big sell on close orders, and they just kept pushing the price down, and then there was a big trade that happened, at those big negative rates. And there's lots of situations where this happens. I mean, it can happen with people having shorts that need to get covered if the price gets high enough. It can happen with stops, and the regulators have tried to reduce those situations, where people used to put stop orders in, stop loss orders.
They've gotten rid of the NYSE, I think, no longer hold stop orders because they were just
because
destroying
if people
retail
knew that they're
investing.
there, people would try to push things down to stops or push things up to stops, on the other side. So there's all these different things that are out there, but the markets have gotten pretty efficient about them. The regulators have are worried about them. You have index inclusion, like index inclusion on, is another kind of trade on close situation, but the markets can get pretty efficient about this, because if everybody knows about it, and if there's enough capital, then the anomaly should get competed away and people should respond to it. So, I think in general, like just saying, let's see if we can, push silver up and then we can all get out, that probably is a pretty tough thing to make work. But if there's a lot of shorts out there, and you kind of know that at a certain price the shorts have to cover because they're running out of capital, then that can work better. But it's kind of unusual that you ever get shorts that are so concentrated and so big like that. I mean, it takes that GameStop is unusual because this doesn't happen.
It's a surprising level of short interest. Like I had to kind of go through the rules to work out exactly how it worked a while ago. I guess in leading from your LTCM to Elm journey, I guess, what are your thoughts on a lot of the kind of more aggressive sort of hedge fund style trades like shorting stocks or like bond arbitrage? Because obviously you've moved away from that more towards a more standard approach to investing, which you feel is more likely to grow your wealth.
Well, and makes more sense for individual investors. I think that that certain hedge fund strategies might make sense for large institutional investors as parts of their portfolio, but in general, for individual investors that don't have the resources that a Yale endowment might have at their disposal, or their connections, maybe some hedge fund strategies work, but for individual investors, I think it's a tough call to make sense of having that within your portfolio, and especially for U.S. taxable investors. In general, hedge funds have a terrible tax treatment in terms of not being able to use itemized deductions and miscellaneous itemized deductions on management fees, and not getting much in the way of deferral and so on. I think that one of the sort of the you could think of the spectrum of hedge fund activities, as being sort of close to arbitrage type activities, where you're doing longs versus shorts on things that are almost the same but have a valuation or price discrepancy, all the way over to more subjective macro strategies, that are trading in very liquid instruments, maybe don't have a lot of leverage because there's a lot of risk in just the price action of things. And, I think on this side that's kind of close to arbitrage, or the relative value side, I think it's really a tough business for hedge funds. And, that a lot of the failures and blowups that we've seen historically in hedge funds have been long short fixed income funds such as LTCM, but there have been others. And the difficulty is that if you have two things that are really the same, once their prices have diverged from each other, it's like the behavior can be so weird, because they should be the same and they should be tracking each other, but now they're not. Then it's like, well, what is causing, what's driving that exactly?
Well, once it gets crazy, it can keep getting crazy.
There's no real limit on it, right? I mean, there's no limit. So you look historically and it's like, oh, that gives me some idea, but that doesn't really give you much of an idea. And there's just no safe level of leverage really that you can apply to that. It really depends upon the flow dynamics in terms of whether somebody's going to get stopped out and need to liquidate, and then where's the next person that's willing to put that on their books. So I think that the relative value trading makes a lot of sense as a small part of capital that's being used for other things. So ironically, or maybe paradoxically, I think that those activities make sense within big financial institutions, big banks, for instance. That I think it makes sense for JP Morgan to be doing some of that activity as a small part of the overall activity of JP Morgan. But with a standalone pool of capital, I think it's dangerous to do that. And I think that's, at Salomon Brothers, I think it made a lot of sense what we were doing. It was I think it was a sensible part of the business mix of Salomon Brothers, as long as it was kept small enough relative to Salomon's capital. But as a standalone pool of capital, I'm not that. I don't think it's that great as a business, as a small part of another hedge fund. So does it make sense for some large hedge fund group to allocate 10% of their capital to this? Sure, that's fine also. But as a standalone pool doing it, I think it's a tough one. And that's why there aren't that many, you could really list on the fingers of your hand the number of successful, highly leveraged, long, short, relative value hedge funds out there. Then as you move along the spectrum, the leverage should be going down, so that's the highest leverage activity. And then as you go all the way over to, macro funds, they shouldn't, they tend not to be using a lot of leverage. They can use a lot of options to manage their risk and to get their exposures and so on. And, there are, talented managers out there. I mean, the problem with hedge funds is that the really successful hedge funds just go private, right? So, here's Medallion Fund, private, making a 75% return, and it's like, oh well, but then they maybe they make $10 billion a year on Medallion, but then they have a year where they've lost investors $25 billion in these publicly available sorts of strategies. So it just really tells you, like, geez, when somebody really finds, that great, when somebody kind of breaks the code in some way, okay, that's great for them, not so great for hedge fund investors.
I even think there's an interesting thing where a lot of time people ask me, should they invest in hedge funds? And they're always surprised that I say usually no, even though I've spent my whole life in the industry. But I think one of the reasons is just that a regular investor can't necessarily even understand. And I don't mean that they're not smart enough to understand. I mean that the risks are sort of hidden. And before things went wrong at LTCM, it wasn't obvious what would go wrong. And a good example, like when you talk about relative value and how it shouldn't necessarily go too horribly wrong, the Volkswagen spread from, what was that, in around 2008. And once again, it made no sense, but once it started going wrong, it just, there's no end to it.
I mean, that's one of the most amazing episodes out there. I mean, and it's just it's like every couple of years, it's like the most amazing thing you could ever imagine happens, and the ability of the markets to create new narratives and new surprises, is just remarkable. Yeah.
It does seem that the 100-year storm comes about once every 2 years in stock markets.
Yeah.
So my next question then is, so you had done all of this and then you moved to, you set up Elm Partners. Elm Partners is, you didn't want to just index. Tell me why you didn't want to just index.
Well, I guess the two reasons, okay? So the first one is a sort of a logical, well-grounded reason that the amount of risk that one should take in their portfolio should be proportional or a function of the attractiveness of the investment opportunity set. So when equities have a higher expected return relative to safe alternatives, all else equal, you should want to have more of your money invested in equities. And when equities are offering returns that are close to or much closer to risk-free alternatives, you should want to be taking very little equity exposure. Assuming this world of equities and risk-free assets just as a starting point, which is a good representation actually of the opportunity set. So you do want to dynamically scale up and down, when you think expected returns are higher or lower, assuming risk is relatively long-term risk is relatively constant. And then the question is, well, can you observe and estimate different expected returns on equities relative to low risk assets? And the answer is yes. I mean, that the simplest metric is using the earnings yield as an estimate of the long-term expected real return of equities. So I look at earnings divided by the price of what I'm buying. I could do it cyclically adjusted using the last 10 years as popularized by Bob Shiller, or I could look at last year, or I could look at a forward, whatever it is. But somehow the earnings yield is a good estimate of the long-term expected real return of equities. And historical data supports that, and logic also supports that. The idea that companies, that if companies were not paying if companies were paying out all their earnings as dividends, that they would be able to keep their earnings in line with inflation. And if they retain earnings, they can grow their earnings faster than inflation. And that's what we've seen, and it makes sense. So we have an estimate of the expected long-term real return of equities. We can see the long-term expected real return on government bonds, especially easily today that we have index-linked bonds, inflation-linked bonds in all of the major economies. So we can just compare those two, and when that difference is big, as it is today, actually, relatively big today, you should want to have more of your portfolio in equities than when it's low, like it was in 1999, when TIPS were yielding about 4%, and the earnings yield of equities was around 4%. They were pretty close to each other. You probably didn't want to have a lot of equity risk in 1999. So fundamentally, and this has nothing to do with markets being inefficient. It has nothing to do with alpha. This is just pure, sensible, common sense thinking and financial economic thinking as well. So that means you should change your allocation over time as the excess expected return of equities is changing. The second reason, so that's the first reason. The second reason is that behaviorally, virtually nobody can maintain a static allocation to equities over time. It's just humanly very difficult to do that. That we read the newspapers, we turn on the TV, whatever, and we just want to change things, So, we might start off with, I think I just want to be 60% in equities for the rest of my life. And then a year later, you change it to 63% or 55%. And you're just, you're going to do that even if you sort of mentally committed. Now, I think these days there are some ways of like if you have a 401k plan and you've invested in a target date fund, you probably are going to be more, people are more static today than they used to be. But still, there's this behavioral urge. And sometimes it just gets overwhelming, so like the worst thing is to be static for 5 years. And then finally, it's like, I can't take it anymore. The market's down 30% and you just blow out of all your equity risk. And then you don't really have a strategy for getting back into it again. So it's like, oh, that was good. I'm glad I sold out because the market kept going down. But then you forget to buy back. And the next thing you know, it's higher than where you sold it. And you go for 5 years being all in cash.
Jack Schweiger had a very interesting piece in one of his books, Market Sense and Nonsense, that showed he did research on how people invest in funds. And he looked at that people, even in the best performing funds, people tended to lose money. And the reason they lost money was they kept changing. They always added after a good period and always cut after a slump.
Yeah. There's been lots of studies of that. It's, it's the comparison of what they I think they call it, the comparison of investor returns versus fund returns. I think that's the way that it's often characterized. So you look at the IRR of the fund itself, a dollar invested, and where did that go? And that can be 400 basis points higher than the IRR experienced by the money going in and out of the fund. It's remarkable. And Dalbar and others have quantified it, and there's lots of papers out there on that.
Yeah. Now, the other thing you do at Elm Partners is a lot of international diversification, right? And how do you deal with that? Are you looking for sort of global value and reallocating globally based upon CAPE ratio, or how does that work?
Well, our baseline, the baseline of the portfolio before we increase or decrease based on the relative attractiveness of the different regions. Our baseline is highly diversified. We have in our baseline portfolios, it's about 50% US and 50% non-US, which we think is actually pretty overweighted to the US as it is, although the average US investor has about 10 to 15% non-US exposure. I mean, the starting point is just thinking about the market portfolio and getting more diversification through international, through owning everything. I mean, the starting point is you just want to own everything that you can own efficiently. And so that's the whole world. And then you think about, how big is the US, in the world? Well, on a population basis, it's whatever, 5%. On a GDP basis, it's, 20% or 15%. On a even on an earnings of public companies basis, it's like 30%. On an unadjusted market cap basis, because that MSCI and FTSE both do float and investability adjustments. If FTSE and MSCI didn't do any adjustments at all and just looked at the market cap of every single publicly listed equity, U.S. equities would be 35% of global market cap. Now, adjusted for float and investability, FTSE and MSCI put the US at 55%. So there's a 20% difference for the float and investability considerations that they have. But clearly, I mean, the UK at one point was 50% of market cap, and now it's 5% of market cap. And I think that as the world develops, which is a wonderful thing. The U.S. will, we'll see some convergence over time in per capita GDP across the world. And as we see per capita GDP converging across the world, we'll see market cap of equity markets converging to population. And, and we'll see the U.S. down at 10 or 15% before long. I mean, at the moment, the U.S. has the U.S. has a valuation on earnings, which is probably close to 2 times the non-U.S. valuation, because for a whole variety of reasons that we can speculate on. We don't know exactly why it is, but, the U.S. is trading on kind of twice the multiple of the rest of the world.
There's a good book called Triumph of the Optimus by Elroy Dimson, where he looks at the very long history of equity market return. I think it's actually markets in general, but I pay attention to the equity side of it. And he shows that the surprising thing that even though the United States, like the return of equities in the United States looks amazing over the last 100 years, but a lot of people say, well, that's because the United States was sort of an emerging market that emerged. And that the global markets, that equity ownership in general isn't that good. And actually, Elroy's research shows, we'll say, for example, Britain, that over the same period went through 2 world wars in which they were almost invaded, plus the loss of an empire, and you get very similar returns. And in fact, even a place like South Africa, just globally, there is a return to investing in company ownership.
Yeah, I mean, you're investing in human productivity growth, right? I mean, you're investing, right? I mean, it makes sense that that investing in equities is giving you sort of this participation in per capita GDP growth, which is coming about through productivity, innovation, et cetera. So it's I mean, it does. There are times when it doesn't. There are times when the market. Like as I say, in 1999, we had this period where, long-term real rates on TIPS or index-linked bonds was around 4%, and equity markets, were probably offering a 4, 5, 6% real return, and it just made more sense to own 30-year bonds at that point, away from taxation issues. It made sense to have most of your money in 30-year bonds than it did to have it in global equities. And it's great that we have these index-linked bonds now so that we can really see this, because before U.S. TIP started in 98, 99, and index-linked gilts started when maybe mid-80s or so for the first few index-linked gilts. But it's a shame that we don't have that history going back, because that's really the thing you want to look at. it's really hard when it's so hard to predict inflation. We really don't know what was going on prior to that.
Now, one of the things I really enjoy, I think probably for 5 years or more, I've been signed up to your mailing list from Elm Partners. Now, that's available to anyone, isn't it? Like anyone can sign up.
Absolutely, yeah. We love for people to read our stuff and to interact with us.
Well, you do great papers. Like most investment firms, if you sign up for their mailing, at least I delete them largely unread. But I look forward to your work because it's thought-provoking research, and you had a really interesting one on diversification and inequality a little while ago. Can you explain that a little bit to the audience, the sort of inequality argument that you have?
Yeah, it's one of the things that we've written about that I really like the most. Maybe it was our timing of sending it out or whatever, or maybe it was just the way we wrote it, that didn't get as much traction and discussion as we had hoped. But there's been all this talk about the forces creating inequality, and we have Thomas Piketty and his crew, with the R minus G argument, which really is I don't subscribe to, that the return on capital is the
return on capital, in the long run, it doesn't seem to me that it can outstrip G. Like in the short run, it can, but they're intrinsically linked to each other.
Yeah, exactly. And that empirically, we just don't see it. I mean, he always sort of brushes over the fact that, we have this inequality, but it's all different people rising to the top, that the rich list is really different than it was 30, 40 years ago. Anyway, so there have been other, papers and on what things might be causing inequality. And so there was this paper that was called the yard sale model, where it's like people are flipping coins with each other, and whoever gets lucky and wins is in a better position to extract more wealth from all the people that have lost, so to speak. And that's this yard sale model. And we were thinking about it, and it's like, well, that doesn't, feel that good. And then we were thinking about this research that this Professor Bessembinder did, maybe down in New Mexico is where he's based. I don't know if you've seen that, but he did this, some big data look at individual equities, and he found that that the average stock, or that 50% of individual equities have underperformed treasury bills.
Oh, I have seen this, yeah.
Yeah. I mean, it's a pretty well-known finding that he had. And so, and it's like, well, what's going on here? The market has outperformed treasury bills by 6% or something, but over half of the companies underperform treasury bills. And, and the reason for that is that, in general, stocks are doing sort of a geometric Brownian motion, right? And so their arithmetic returns are close to 6%. Their arithmetic excess returns around 6%, but their geometric compound returns are closer to treasury bills. In other words, that stocks can go up tenfold, but they can only go down 100%. They can go up 6,000%, but they can only go down 100%. Is the easiest way of seeing that. And so, we were thinking, like, is it the case that if investors were overly concentrated in a small number of individual names, if they were taking too much risk in a small number of names, how far could that go in explaining the inequality in wealth that we see in the US or other places, the Gini coefficients that we see in these places? And so we ran some simulations where we said, well, imagine that you have a population of people, you have 1 million or 10 million investors, and all of these guys own different sets of 3 or 4 stocks. How does wealth inequality sort of emerge from that? And what we found is that, you could pretty easily, we put some bells and whistles to test out the robustness of it. And we found that you could pretty easily generate the kind of wealth inequality that we see in the US and other places from that. And, the really positive, conclusion that you sort of take from this is that the more that investors have been moving towards diversified portfolios through indexation or mutual funds in general, the more you get this positive externality of it. It's good for individual investors themselves, and it's also good for society if you feel that wealth inequality has kind of got a negative externality to it. And there's been all kinds of other studies done, like in places like Sweden and India, that are showing individual investor behavior, and how historically it was very concentrated in just a few stocks. I mean, in the US, the Fed has a study where the median number of stocks in an individual brokerage account in the 1950s was two. Half the people had one stock. Half the people had one stock in their brokerage account, and the other half of the people had more than one stock. But now, that's all changing a lot, and that's a really good thing. We're kind of seeing a little bit of a blip right now. Like the Robin Hood crowd, et cetera, is tends to be pretty concentrated, and we're kind of seeing a little bit of a blip right now. But I think overall the trajectory is, the people are investing much more sensibly today. And it's a combination of the availability of the right instruments and the right programs, right? So you have a 401k, you're gonna be like bumped into a good option to begin with, no matter what you think, and then you can change it if you want. But the availability of these great highly diversified portfolios at low cost is got a huge social benefit. So anyway, so that's what we wrote about. And yeah, it's really interesting just to see how concentrated stock holdings can take you to as unequal a place as you can imagine.
Now, the other one I was going to ask you about, because I kind of love it, and it almost links back to what we were speaking about just a minute ago, was the Costanza investing, the levered ETF and sizing bit. Because I worry when we talk once again about this GameStop thing, or people piling into silver or whatever people might be doing sort of over the last week, that one of the things they're not taking into account is the importance of correctly sizing their bets. Do you want to talk a little bit about that idea?
Sure. Investing in general, and I'll say that we're trying to write a book on this topic, although it's looks pretty far out in the future. But in general, right, investing, there's two things that you need to do in investing. The first one is you need to figure out what you want to invest in. You got to figure out what you think is going to go up, what you think is not going to go up, and sort of come up with, the preferred things that you want to invest in. So it could be a global equity index fund, or it could be, some more concentrated set of holdings or whatever. But the first thing is investment selection. And, like 99% of 99.9% of what we hear about and read about and learn about even, is valuation and, and trying to figure out what we should invest in. What's the next thing that's going to go up? What's going to go up the most, et cetera. And then building a portfolio from that. But the other thing that you have to do, right, is you have to size it. So once you've decided what you want to own, you have to make a sizing decision. How much do I want of that sort of ideal collection of trades or investments that I want? So part two, or the second part of the investing process, is the sizing question. And the sizing question is arguably more critical than the selection question, because if you get the selection question wrong, but the sizing decision right, you'll be okay. You're going to lose money, right? You're going to lose some money, and you won't be too happy, but you'll be okay. You
live to fight another day, right?
You live to fight another day. But you can get the selection question right, but the sizing question wrong, and you're bankrupt, right? So an easy way of thinking about it is, like, if you knew, like let's say that you're living in 1900, and I tell you, the stock market's going to go up on average 9% a year from now until 2020, 9% a year, and you're like, really? Or for sure? And you say, yeah, that's it. It's 9%. Okay, I'm telling you right now, it will be a 9% compound return from now until 2020 for 120 years. and you say, oh my God, if I just invest, $10,000, I'm going to be a trillionaire by the time I get, by the time my great grandchildren get to enjoy my $10,000 investment. And then, but then you think to yourself, well, if it's a 9% return, geez, why do I just satisfy myself with investing 10,000? I mean, I've got $10,000. Why am I going to satisfy myself just by being with $10,000 in investing in the market? You know what I'm going to do is I'm going to leverage. I'm going to invest $30,000 in the market. I'm going to borrow $20,000, and I'm going to invest $30,000 in the market. And so you do that, and it's like, wow, this is great, and you're like, you're making all this money to begin with, et cetera. And then unfortunately, you just hit the first time that the market is down 70% and you're wiped out. So you never made it. And so you had the right investment decision, which is the stock market's a great thing to invest in. But if you get the sizing wrong, you're wiped out. And, I mean, in general, when you are not using leverage, the sizing decision becomes more about, not about being wiped out, but about having really subpar returns. And so you can see that, like, in our paper that we wrote about leveraged ETFs, you could see how, there were these cases where the ETF, where the underlying thing in the ETF went up 2x, but investors in the ETF lost 30% because of all of the volatility and the rebalancing, et cetera, that you have to do when you're using leverage. And even on an unleveraged basis, you can very much get this effect. So sizing, we think that sizing is really critical and should get as much attention from investors as investment selection. And indeed, I think that, we certainly, at the public level, right, we see, which is where our discussion started, talking about entrepreneurs that are 120% invested in their company because they actually borrowed money to pay taxes and to live on and to buy their house and cars. So they're multi-billionaires, but they have a couple $100 million of debt. They're all invested in their company. And, they could be in a lot of trouble with that sort of sizing decision, that they've made. But, when they're that rich, you kind of say, oh, well, whatever, what's the worst that can happen to them? But, that's the puzzle of the missing billionaires is, we should, if people were investing, that if people invested sensibly, we should have a lot more wealthy people today than we have, based on wealth accumulations that we've seen over the last 100-odd years.
Yeah. Well, you did a number of years ago. Was it a TED talk that you did on that? What I'll do is I'll put a link to that in the description, because
the puzzle of the missing billionaires. Exactly.
Yeah. Well, I guess I should let you go. I've taken up over an hour of your time. Thank you very much for coming on. It's been really interesting. And when we're both in London, we'll have to, and when you're allowed out in public again, we'll have to meet up at some point.
Yeah. Well, I really enjoyed this, as I did the seminar you invited me to in London. So it's really, really great. I hope we keep having opportunities to chat about things.
Sounds great. Okay. Talk to you later. Bye.
Thanks, Patrick. Bye-bye.